Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. The financial technology sector is just, well, it's a whirlwind, isn't it?
Yeah.
Such rapid change, incredible innovation happening almost constantly.
It really is. Feels like you blink and something new has emerged.
Exactly. And, in this kind of fast-paced environment, trying to understand the strategic moves behind the headlines, the why of it all, that can really bring some clarity.
Mm-hmm.
So today, we're going to really dig into a recent significant corporate discussion. It unveiled some genuinely compelling developments across two major platforms. We saw some strategic pivots that could, well, redefine where they're headed.
That's right. And our mission here really is to pull out the most important insights, maybe some surprising facts from that dialogue.
Yeah,
Think of us as your guides, sorting through the metrics, the strategies. We want to help you grasp the why behind those numbers. And importantly, what it might mean for the future of these platforms and maybe even, the wider financial world, trying to cut through the noise.
absolutely. Get straight to what matters. And the big theme, it just jumps right out, doesn't it? A really strong return to growth.
Definitely.
Significant product velocity, they're moving fast, and some really ambitious plans for expanding down the road.
Mhm.
And all of this seems underpinned by these very strategic investments, key areas like artificial intelligence, and some pretty unique financial offerings, too.
Right.
So for you, right off the bat, when a company this size signals such a definitive shift back to aggressive growth, what does that instantly say to you? Is it just pure confidence, or is there more to it?
Well, it definitely screams confidence, but it's usually more nuanced than just pure optimism. It often means they feel past investments are really starting to bear fruit now. And there's a clear, deliberate plan to, capitalize on that momentum.
Yeah.
When a company says, we're back in growth mode, especially one that's been around a bit, it's not just talk.
It's a signal.
It's a strategic mandate, exactly. It implies they've moved past maybe a period of internal tweaking or consolidation even, and now they're ready to really push out, expand their footprint, grab market share, push the product boundaries.
Makes sense.
For anyone watching the market, it signals, high conviction in their pipeline, their ability to execute fast and at scale. But it also sets a higher bar, right?
Just expectations go up.
Exactly. The market will expect that acceleration to keep going.
Yeah.
It suggests that, whatever internal roadblocks or external headwinds they might have faced, they feel they've either solved them or they're actively working around them now.
That deep conviction really did come through from the leadership. The chairman and co-founder specifically mentioned a definitive return to growth mode across the company. And like you said, it isn't just about the impressive numbers, though we'll definitely get to those. It sounds like a cultural thing, too, an operational shift.
Yeah.
Faster execution, broader investment.
Right.
So when we hear phrases like shipping faster from a big fintech like this, what does that actually mean day to day? How do they speed things up with complex financial products?
Yeah. Shipping faster here isn't just, typing quicker.
Yes.
It's a whole transformation, operationally and technologically.
Okay.
It basically means speeding up the entire product development cycle,
Right.
from that first idea all the way to getting it out there and seeing users adopt it.
Right.
For a company this big that takes streamlined decisions, empowering smaller agile teams, and crucially, using advanced internal tools, technology is key.
Like the AI tools they mentioned.
Exactly. They talked about taking a complex feature, like Cash App pools, from just a concept to a working pilot in only a few months.
That's fast.
That's incredibly fast. And it's not just working harder, it's working smarter. It's integrating things like AI directly into how they build stuff. Their internal AI coding tool, Goose, I think they called it.
Yeah, Goose.
Right. Apparently almost every engineer is using it now. It's like an AI co-pilot.
Right.
Automates routine coding, suggests improvements, finds potential bugs, even writes test cases.
Wow.
So the engineers can focus on the bigger picture, the innovative design, the strategy. That link between internal tech and external product delivery is vital.
So it directly speeds things up.
Absolutely. Lets them innovate faster, experiment more cheaply, and get that crucial customer feedback way quicker. It really signals they're moving past any slower periods, leveraging tech to scale and improve the customer experience more effectively.
Yeah.
It's about building that culture of just constant high-speed iteration.
So the internal tech is literally accelerating the external products. That makes sense. And the results, well, they seem to back it up. Q2 2025 gross profit hit $2.5 billion. That's a 14% year-over-year acceleration, up from 9% the previous quarter. So accelerating growth.
That acceleration is key.
And adjusted operating income climbed to $550 million, up 38% year over year. That led to their highest quarterly adjusted operating income margin ever, 22%.
Yeah, those are strong numbers.
What do these figures, especially that accelerating profit and the expanding margin, tell us about how efficient those recent investments are? Are they really getting bang for their buck from shipping faster? Or are there hidden costs, maybe?
No, these figures are exceptionally strong indicators. It's not just top-line growth. It's showing remarkable improvement in efficiency and underlying profitability, too.
Okay.
Accelerating gross profit growth means they're not just making more money. They're doing it at an increasing rate. That's a powerful sign of capturing the market, strong product value.
Right.
And then you couple that with the expanding margin hitting that 22% high, it tells you pretty unequivocally that revenue growth is seriously outpacing operating expenses.
Just where that rule of 40 comes in, right?
Yeah, exactly. It's a benchmark people use for tech companies, growth rate plus profit margin. With 14% gross profit growth and 22% adjusted operating income margin, they're at 36%.
So close to 40.
Very close.
Yeah.
And for a company this size, especially one investing heavily in growth like they are, being that close is exceptionally strong. It shows those investments in innovation, in go-to-market, in that shipping faster idea, they are yielding efficient, healthy returns.
Right.
It underlines a very strong financial position, like their investor relations folks pointed out. They're managing to grow aggressively and become more profitable at the same time. That's a tough balancing act.
Yeah, definitely not easy. It suggests discipline even while they're expanding.
Precisely.
So effectively hitting the gas on growth while tuning the financial engine. That's powerful. And this conviction, well, it's clearly reflected in their decision to raise the full-year guidance. They're projecting continued acceleration. For Q3, they're looking at $2.6 billion gross profit. That's 16% year-over-year growth. And they expect to exit the year with 19% gross profit growth and still over 20% adjusted operating income margin. That sets a strong pace for 2026.
It really does.
What gives management that kind of strong conviction? It's not just saying we had a good quarter, it's a commitment to sustained accelerating performance.
Yeah, raising guidance like that, it typically reflects a potent mix of things. Strong internal data, successful product launches maybe exceeding expectations, and effective go-to-market strategies that are really working and scaling.
So they're seeing it in real time.
Exactly. They're not just looking backwards. They're seeing forward-looking evidence that these growth mode initiatives are leading to real compounding results.
Okay.
I mean, the COO and CFO specifically mentioned seeing strong data points in Q2 for key drivers across both Cash App and Square.
Like what specific?
Things like strong traction in their Borrow product, rapid adoption of new Cash App commerce features like that post-purchase BNPL, and also the contribution they expect from Proto, their Bitcoin mining thing, which we should definitely talk more about.
Right, yeah.
So it's not just optimism, it's grounded in a really granular understanding of customer engagement, product adoption, a solid sales pipeline. Plus, getting added to the S&P 500 recently doesn't hurt.
True. That's external validation.
Right. It reinforces their market position, their financial health, boosts investor confidence. It suggests the internal signals they're seeing are strong enough not just to meet, but probably exceed higher expectations. That makes the raised outlook feel very credible. They're not just hoping for acceleration, they're seeing the early signs that it's happening and set to compound.
Okay, so we've unpacked the financials. Impressive reacceleration, shipping faster is clearly more than just a slogan. It's showing up on the balance sheet. That brings us to how this speed is actually impacting the platforms. Let's zoom in on Cash App now. It's the engine for so much of this growth. How is this intensity affecting the user experience, the strategy there?
Yeah, Cash App's evolution is fascinating.
What were some of the standout products in Q2 that are really driving this reacceleration? We heard about CashBot, the AI support.
Right, AI for customer experience.
And Tap to Pay for Cash App Business. But then there's Cash App Pools, which sounds really different. What's the common thread here? Are they all shooting for the same goal?
I think the common thread definitely is strategically deepening Cash App's role in people's everyday financial lives and expanding its reach by just fostering more engagement, more utility.
Yeah.
CashBot uses AI for efficiency, makes it more user-friendly.
Right.
Tap to Pay for Cash App Business pushes Cash App more into the merchant space, beyond just P2P.
Right.
But Cash App Pools, yeah, that was really intriguing. It's a calculated move towards what they call multiplayer money, a truly social take on finance.
Multiplayer money. I like that.
Yeah. It's not just about individual transactions anymore. It's enabling collaborative spending, managing money together in groups. And the speed they developed it, concept to pilot in months, that shows that shipping faster thing again.
So what does it actually do? Group trips? Gifts?
Exactly. Create shared funds for group trips, gifts, splitting household bills, maybe community fundraisers. What's really smart is it can bring new users onto Cash App, even if they're not on it yet.
How does that work?
They can contribute using things like Apple Pay or Google Pay, even if they don't have a Cash App account initially. It pulls people into the ecosystem.
Ah.
And the market data they cited is striking. 60% of U.S. adults apparently pool money for something sometimes.
60%? Wow.
Yeah, it underscores this huge kind of underserved need that pools hits directly. It taps into existing social behaviors to get new users and deepen engagement for existing ones. It positions Cash App less as just a payment tool and more like a whole financial ecosystem, handling more complex group money needs.
That 60% figure is really something. It makes you wonder why a multiplayer money feature wasn't core to a money app way sooner.
That's a great question.
What does its rapid development now tell us? Is it about consumer behavior changing or the tech finally catching up? Is fintech finally cracking social finance beyond just sending cash back and forth?
I think it's a mix of factors converging.
Yeah.
On the consumer side, yeah, people are way more comfortable with digital finance, especially younger folks who are naturally collaborative.
Right. Group payments used to be messy.
Exactly. Endless Venmo requests, awkward spreadsheets. Technologically, the platform itself is mature enough now to iterate quickly, integrate complex stuff like secure group accounts, cross-network payments without sacrificing speed or security.
And the internal tools help, like Goose.
Absolutely. It shows fintech is moving beyond simple P2P. We're seeing tools that actually mirror and help with real-world social money stuff. Less about individual transactions, more about fostering a kind of financial community in the app.
Capturing more of the user's total financial life.
Precisely. Especially the collaborative parts. It could unlock huge network effects. Invite friends to a pool, you're implicitly inviting them to Cash App.
Yeah.
It's a strategic step from just transferring money to managing money together.
Really framing it as that central hub. And speaking of expanding reach, the COO and CFO mentioned the reacceleration of their buy now, pay later BNPL gross profit, driven significantly by post-purchase BNPL on Cash App Card.
Yeah, that's a big one.
What makes that integration so powerful? It seems like a natural fit, but the adoption rate suggests something more is going on.
It is a natural fit, but its impact comes from plugging a flexible financing option right into everyday spending habits. It meets a need in real time.
So post-purchase means you decide after you buy.
Exactly. Cash App Card users can take eligible purchases they've already made and turn them into installment plans after the fact. That flexibility is huge for managing cash flow. You don't have to commit at the checkout.
That's interesting.
And the numbers show it's resonating. It crossed 1 million monthly actives, hit a $2 billion originations run rate by July. That's serious adoption.
So how did they get it so right, so fast?
What's really smart is how they used what they learned from their existing borrow feature.
Ah, leveraging past success.
Right. They specifically said post-purchase BNPL is actually outpacing borrow's early trajectory, both in attach rates, how often people use it, and, crucially, maintaining really low loss rates.
Better performance than borrow initially?
In some key metrics, yeah. It's not just a new product. It's an intelligent evolution. Shows they learn and apply those lessons. It drives BNPL growth overall by making financing seamless, accessible, adaptable for a huge user base already using the card daily. Shows they really understand consumer habits.
It's clear Cash App is moving way beyond just P2P. They really are aiming to be the money app for the next generation.
That seems to be the goal.
It's not just about user numbers, but deeper engagement. Paycheck deposit actives keep growing, over 2.8 million now. But they introduced this new, broader metric, 8 million banking actives.
Yeah, that's a significant shift in definition.
What does that new definition tell us about how people are really using Cash App? Does it change how we should think about its role?
It absolutely represents a profound strategic shift in how they measure engagement, and yeah, it fundamentally changes the perception of Cash App's role.
How so?
Well, before, the focus was heavy on direct deposit, a strong sign of a primary bank relationship, sure. But their research showed tons of other users already saw Cash App as their main financial partner, even if their whole paycheck didn't go there.
Okay.
So these 8 million banking actives are defined differently. Either they deposit a paycheck or they consistently spend at least $500 across Cash App every month.
$500 a month. How does that compare?
Well, the average U.S. debit card spend is apparently around $900 a month. So spending $500 through Cash App shows these 8 million users are largely making it their top-of-wallet choice for a big chunk of their spending.
Got it. So they're really relying on it.
Heavily. And the engagement numbers for this group are just, well, astonishing. They generate over $250 in gross profit per active annually. That's 3 times Cash App's blended average revenue per user.
3 times.
Wow. Yeah. And this group averaged over 40 transactions across Cash App in June alone.
40 transactions in 1 month.
That's right. This data just completely shifts the view of Cash App from just a P2P app or a side tool to a genuine primary banking platform for millions. They're capturing a significant and deepening share of users' financial lives. It's becoming the central hub.
That is remarkable engagement, moving from niche tool to primary hub. And given that trust, that central role, they're looking at higher borrow limits for paycheck depositors, expanding benefits based on spending. What does that signal for their banking strategy? Are they basically doubling down on becoming a full-on alternative bank? And what about their own credit scoring?
Precisely. It signals a strategic, deliberate doubling down. They want to be that comprehensive digital banking alternative, especially for people maybe not perfectly served by traditional banks.
And borrow is key to that.
Absolutely central. Its growth is incredible, nearly doubled year over year, $18 billion in annualized originations, 6 million monthly actives. That shows the demand is there.
And they're originating more loans themselves now through SFS.
Yeah, Square Financial Services, their own bank, is originating the majority now. That's a key strategic shift. Gives them way more control over the unit economics, lets them expand responsibly, maximize profitability.
Makes sense.
And what's really innovative, a real competitive edge, is their internal Cash App credit score.
How does that work differently?
It's proprietary. It constantly learns from tons of data points across Cash App. Because of that, they can approve an impressive 38% more customers than traditional credit scores, like VantageScore, would, at the same loss threshold.
38% more approvals, same risk.
That's what they're saying. It shows a commitment to expanding financial access, but responsibly. They're maintaining strong unit economics like a 24% annualized net margin for borrow and keeping loss rates really low, under 3%.
So higher limits, more benefits tied to spending. It reinforces Cash App as the main platform.
Exactly. Leveraging their unique data to expand credit smartly. It really sets them apart from traditional banks relying only on external bureaus.
And it's clear Cash App is hitting home with younger users, building loyalty early. They mentioned 5 million sponsored teen actives.
Yeah, the teen engagement is huge.
And 1.7 million who've already graduated from sponsored to individual accounts. How does that early engagement help long-term? Is it just future customers, or is there an immediate network effect, like a financial social network?
Oh, it creates an incredibly powerful and probably lasting network effect. It's way more than just getting future customers.
Yeah, so
It's cultivating a user base that grows with the platform, generating massive lifetime value. The numbers are telling. Nearly 80% of those teens get a Cash App card. Over 25% use Cash App Pay.
So they're active right away.
Deeply engaged from the start. It embeds Cash App into their very first financial habits. As they get older, their needs evolve, saving, investing, borrowing, and Cash App aims to be right there, already established as their trusted partner.
Building loyalty from day one.
Exactly. That demographic focus, plus smart, culturally relevant marketing for that audience, it's absolutely key to re-energizing overall network growth. They expect the full compounding impact of this youth strategy to really show up strong into 2026. It's a long game, but potentially huge returns.
Okay, we've seen the impressive acceleration in Cash App, clearly a major growth engine. Let's pivot now to the Square side of the business. That also showed significant acceleration.
It did, yeah. Square had a strong quarter too.
Year over year, gross payment volume, GPV growth hit 10%. Gross profit growth was even better at 11%. So not just volume, but healthy monetization, a strong bounce back. What's really driving this resurgence in Square? Is it mostly new sellers coming on board? Or are existing sellers using more services, expanding?
It really seems to be a powerful mix of both. Signals a broad strategic resurgence.
Okay.
They attributed the growth to changing perceptions among both new and existing customers
Yeah.
about what Square can do, its value.
And what's changing those perceptions?
2 main things. based on what they said. First, impactful new products launched over the last year that make Square more comprehensive, more competitive.
Right.
And second, significant strategic investments in how they reach customers. More marketing, a bigger field sales force, targeted partnerships,
And those investments are working.
clearly paying off, attracting a wider range of new businesses, and also deepening engagement and getting current merchants to use more stuff.
Any examples?
Yeah, they highlighted wins in the quick-serve restaurant space QSR, mentioned names like Collectivo Coffee, Shane's Rib Shack, and significantly, Ben's Soft Pretzels. That's a 60-location business they actually won back to the platform.
Winning back larger clients is a good sign.
It really is. These aren't just tiny shops. They're often established local businesses, category leaders. Winning and re-engaging them shows Square is increasingly able to compete upmarket, handle more complex needs. That drives higher volumes and better monetization because those bigger clients attach more services.
So it's a refined approach, working across different business sizes.
Exactly. From the microbusiness right up to multi-location enterprises.
That makes sense. Moving upmarket often means higher value. And speaking of sales, they've leaned heavily into expanding those efforts.
They have.
What kind of returns are they actually seeing from investing more in field sales, telesales, both here and internationally? Is it an efficient way to get new Square business? How sustainable is it?
The returns aren't just strong. They seem remarkably efficient. That's why they're scaling it aggressively.
What numbers did they share?
They reported over 20% growth rates in new volume added by these sales channels in the first half of the year. And they expect that growth rate to more than double in Q4.
Double. Wow.
Yeah, shows the immediate impact of having more feet on the street, more people on the phones. And for field sales, which is newer for them, they're seeing a really efficient 5-6 quarter payback on the investment.
Meaning they recoup the cost quickly.
Relatively quickly, yeah, through the gross profit generated. Plus, strong LTV to CAC ratios, lifetime value to customer acquisition cost. Means the long-term value from these customers far outweighs the initial cost to get them.
So the math works out.
The math works out, which is why they're hiring more salespeople. And another healthy sign, forecasted new gross profit added is outpacing new GPV added.
What does that indicate?
Signals healthy pricing and strong attach rates for other Square products as they move upmarket in the U.S. They're not just getting volume, they're getting profitable volume with attached services.
And internationally?
Strong growth there, too. International GPV up 25%, gross profit up 19%. Shows the strategy works globally, and it complements their strong self-onboarding for smaller businesses. It's a really comprehensive approach.
Okay, so overall performance is strong. Growth strategy is paying off. But they did mention some temporary factors hitting Square's gross profit in Q3. Increased processing costs, hardware investments.
Right, some nuances.
How should we interpret those? Are they red flags or just part of a bigger plan?
Definitely important to see those as strategic nuances, calculated investments, not signs of weakness. That's how the company framed it, and the context backs it up.
Explain the processing costs.
Okay, those costs were about a 2-point headwind to Q2 gross profit growth. It came from a deliberate choice to get more operational flexibility and resilience with their processing partners.
So a strategic choice, not just costs rising.
Exactly. It might temporarily increase costs, but it gives them long-term benefits, smoother operations, more adaptability, maybe better uptime for sellers. It's investing in their core infrastructure robustness.
And the hardware investments, like the new handheld.
Similar story. Investments in hardware, especially that popular new Square handheld, are seen as strong go-to-market drivers. Helps acquire new customers, deepen engagement.
They seemed quite bullish on the handheld.
They called it their best form factor yet. Portable, affordable, durable, flexible across restaurants, retail, mobile services. It makes their offering more compelling, more accessible.
So these are investments, not problems.
Right. Calculated investments to fuel future growth, expand their market, gain share. They expect things to normalize, with gross profit and GPV growth roughly aligning by year-end. Reinforces the idea these are temporary adjustments for long-term gain.
Okay, that makes sense. Beyond hardware, Square's also pushing Square AI. Initially, it sounded like it was about customized reports, analytics.
Yeah, that was the start.
But the ambition sounds much bigger now. How is Square AI evolving to really empower sellers? Is it becoming more like a strategic partner?
The vision is definitely ambitious, really transformative. They want it to act like a virtual COO or an intelligent business manager for sellers, regardless of size or type.
A virtual COO?
How? It goes way beyond just reports. It's integrated right into the seller dashboard, where merchants manage their business. The goal is to simplify the complexity of Square's huge ecosystem
How does it simplify things?
by using intuitive natural language, offering proactive insights, identifying opportunities, suggesting actions tailored to that specific business.
Give me an example.
Imagine AI not just showing sales data, but maybe saying, hey, this product isn't selling well on Tuesdays. Maybe try promotion. Or suggesting optimal pricing or the best time for marketing based on local events.
Making it easier for less techie merchants.
Exactly. And crucially, it powerfully drives cross-sell of other Square services, banking, payroll, CRM tools.
Ah, the flywheel effect.
Precisely. The AI makes it easier to understand and use the whole suite. Sellers engage more, adopt more products, rely more on Square, become more efficient, and Square earns more gross profit. It makes complex decisions intuitive.
And what about accepting Bitcoin payments on Square? Seems pretty forward-looking for typical businesses. Is that getting much traction, or is it more future-proofing?
It is forward-looking, but they frame it within their core philosophy. Let sellers accept every form of payment.
Credit cards, mobile wallets, crypto.
Right. Bitcoin, Tether, Circle. The idea is to ensure sellers always make the sale, remove friction at checkout, expand the customer base.
So the optionality.
Maximum optionality, meeting customers where they are now or where they might be heading. As digital currencies get more adoption, offering acceptance keeps Square sellers competitive. It's proactive, embracing the evolving landscape, future-proofing their merchants and their own capabilities.
Okay, that leads perfectly into the broader digital currency picture. They touched on Proto and Bitcoin mining, with news coming soon, apparently.
Yeah, intriguing developments there.
What's the significance of them pushing into mining? Is this a major new revenue stream or something more foundational, maybe an infrastructure play?
It seems significant on multiple levels. Potential new revenue, yes, but also a deep foundational commitment to the Bitcoin ecosystem.
They sounded confident about their miner.
Remarkably confident. Called it the best miner out there. Emphasized its flexibility, customizability, built based on customer feedback to solve existing problems.
So not just entering the market, but trying to disrupt it.
That's the signal. An aggressive strategy to grab market share in mining hardware. Positions them not just as a financial service provider, but maybe a key infrastructure provider in the digital currency space.
And they expect profit from it soon?
Yeah, they explicitly expect Proto to start contributing to gross profit growth in the second half of the year. Shows a dual commitment, facilitating Bitcoin use on their platforms and investing in supporting the underlying network infrastructure through mining.
A holistic approach.
End to end, yeah. Suggests a belief that having influence or control over the foundational layers can strengthen the whole ecosystem for their business, not just relying on the applications built on top.
Their chairman and co-founder also laid out a really strong philosophical stance on Bitcoin, aiming for it to be the native currency of the internet, used as everyday money.
A very strong conviction.
What's behind that profound belief, especially with other digital currencies out there? And what does that vision mean practically for their business?
That belief really comes down to Bitcoin's unique foundational properties, what sets it apart in their view.
Which is?
Its independence.
Right.
It doesn't rely on any single company, government, central authority. That decentralization, proven over 16 years now as resilient, secure, they see that as critical for a truly global open internet currency.
Unlike corporate or government digital currencies.
Exactly. Bitcoin's permissionless nature allows for innovation, economic empowerment in a way others might not. For their business, that independence means as Bitcoin gets more adopted, it could let Cash App and Square enter new markets almost instantly.
Bypassing traditional rails?
Potentially bypassing some traditional banking hurdles or regulations tied to fiat currencies. They see Bitcoin as a fundamental internet protocol.
Like TCP/IP or HTTP?
Kind of. They admit protocols move slower initially than products, but they tend to last longer. And once they hit critical mass, they have a massive accelerating effect on everything built on top. The vision is Bitcoin enabling open finance, aligning with their mission of economic empowerment. It's a long-term, high-conviction bet.
Interesting. But in contrast to that strong Bitcoin conviction, their view on stablecoins seemed much more pragmatic. Cautious, even.
Definitely more pragmatic, yeah.
They said they'd support major ones if people use them, but they don't see a need to offer their own. Why the difference? Why not use their bank license to make their own stablecoin?
That difference really highlights their strategic pragmatism, a focus on actual, observable user demand, not speculation.
So they could issue one, but choose not to.
They absolutely have the capability, the bank license via SFS, but they explicitly said they don't see a big differentiator in doing so right now, or much advantage in many new stablecoins hitting the market.
Their philosophy is support what people actually use.
Right. And currently, they mostly see stablecoins used for remittances, sending money across borders efficiently. If stablecoins get wider use for everyday payments, sure, they'll support the big ones like Tether or Circle, so sellers can accept every form of payment.
But they still see Bitcoin as fundamentally different.
Fundamentally different. Offering unique properties, stablecoins lack independence, decentralization, that global permissionless nature. They believe Bitcoin's inherent traits make it the better long-term bet for the native currency of the internet.
So no point diverting resources unless there's a clear need and advantage.
Exactly. Serve current verified user needs, but keep that long-term vision focused on Bitcoin as the foundational protocol for future finance.
Well, today we've really journeyed through the layers of this company's recent performance, their strategic vision, from that impressive financial reacceleration to the growth engines in Cash App and Square, and that bold long-term view on digital currencies. It's clearly a company moving very quickly, focused on both today's success and tomorrow's transformation, often pushing the boundaries.
Absolutely. And as we wrap up, maybe something to think about is how this relentless drive to ship faster, combined with their deep integration of AI, how that might reshape not just their platforms, but the whole landscape of finance and commerce.
Making complex things simple.
Making things like pooling money, getting flexible credit, managing a business, making them almost seamless, intuitive. What does that accelerated product speed, driven by internal innovation and strategy, imply for how quickly we'll see innovation elsewhere, especially in industries often seen as slower moving?
A potential acceleration across the board.
It suggests a future where digital transformation just keeps speeding up, demanding agility and foresight from everyone.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.